Welcome back to the channel. Today, we are diving deep into Jardine Matheson Holdings, a company with a rich history and a fascinating, diversified portfolio. If you're an investor interested in Asian markets and long-term value, you will want to stick around, because there's a lot more to this company than meets the eye, especially concerning its recent financial results. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. So, who is Jardine Matheson? It's a venerable diversified investment company, tracing its roots all the way back to its founding in China in 1832. Imagine that history. The group holds its primary listing on the London Stock Exchange, with secondary listings in Bermuda and Singapore. Their core strategy is clear: deliver superior, long-term returns for shareholders through a portfolio of market-leading businesses, primarily focused on the dynamic economies of Greater China and Southeast Asia. They aim to leverage growth opportunities from urbanization and expanding middle-income populations across Asia. This isn't just one business. It's a vast conglomerate structure designed to foster synergies and create value across diverse sectors. Jardine Matheson's operations span 7 primary segments, plus other specialized businesses. This diversification is key to their stability. Let's quickly run through them. Jardine Pacific. This covers engineering and construction like JEC and Gammon, transport services such as Hactl, automotive distribution with Zhang Fu, and a significant presence in the restaurant sector, including Jardine Restaurants and Maxim's. Jardine Motors, focused purely on motor vehicles and related activities. Hong Kong Land, a major player in property investment and development, owning prime office and luxury retail assets in key Asian urban centers like Hong Kong, Singapore, Beijing, and Jakarta. DFI Retail Group, engaged in various retail operations, from food retailing to health and beauty and home furnishings, through supermarkets, convenience stores, and health and beauty outlets. Mandarin Oriental Hotel Group, an international luxury hotel investment and management group, operating high-end hotels and resorts globally. Jardine Cycle and Carriage. This is the investment holding company for JMH's Southeast Asian interests, notably holding a substantial stake in Astra, a diversified Indonesian conglomerate, and Thaco in Vietnam. Other businesses. Their diversification also extends to financial services, insurance broking, heavy equipment, and mining operations. Now, let's get into the financials, and this is where it gets interesting, as it requires a bit of nuance. For 2024, Jardine Matheson reported a net loss of $468 million. This was a significant decrease from the $686 million profit in 2023, resulting in a loss per share of $1.61. However, and this is crucial, this reported loss was predominantly influenced by significant non-cash impairments, particularly within its Hong Kong Land segment. The more representative view of operational health shows an underlying net profit of $1.5 billion for the full year 2024. This demonstrates fundamental operational stability despite the accounting impact of impairments, which are non-cash adjustments that don't directly drain liquidity. This means the core businesses are still generating profits. The Q1 2025 interim management statement further supports this, indicating stable underlying profit compared to the previous year. Looking at the balance sheet, it presents a mixed picture, but with some positive trends. The gearing ratio improved to 14% at the end of 2024, down from 15% in 2023. Net debt significantly reduced to $4.9 billion by March 2025. The company also maintains a sufficient cash runway for over 3 years. However, some external financial strength indicators, such as Guru Focus's Altman Z-score of 0.74, place it in the distress zone, implying a bankruptcy possibility in the next 2 years. It's important to understand that these metrics are highly sensitive to reported net income. Since JMH reported a significant net loss, this negative input would naturally depress such scores, potentially triggering a distress signal even if the underlying operational cash flow is robust. The company's strong operating cash flows and active debt management provide a different perspective. For income-oriented investors, Jardine Matheson has historically been a favorite due to its consistent payouts. Despite the reported net loss in 2024, the company maintained its dividend per share at $2.25. This consistency is notable. Their current dividend yield is attractive, ranging from approximately 5.0 to 5.14%. This is significantly higher than its historical average of 3.4%. A higher yield can sometimes indicate undervaluation if the underlying business is sound. The dividend sustainability, especially with a reported negative payout ratio for 2024, is supported by its positive underlying net profit and strong operating cash flows. The company's strategic focus on capital recycling also provides financial flexibility for shareholder returns. So, while the accounting payout ratio might look concerning, focusing on cash flow and underlying profitability provides a clearer picture of dividend coverage. Jardine Matheson is not sitting still. They have a strategic vision 2035 aimed at delivering superior long-term returns. A critical part of this is capital allocation and recycling. For example, Hong Kong Land aims to recycle up to $10 billion over a decade through asset sales, like the $810 million sale of One Exchange Square. This generates capital for new, high-return investments and enhances shareholder returns, including share buybacks. They remain Asia-focused, capitalizing on demographic and economic trends. There's also a commitment to tech-driven innovation, despite acknowledging their current conservative digital maturity. Segment-specific strategies are also underway. Hong Kong Land is pivoting towards ultra-premium integrated commercial properties, with a major $1 billion Tomorrow's Central Transformation project. DFI Retail Group is streamlining its portfolio, focusing on high-growth, high-margin businesses like Guardian and 7-Eleven, and expanding its omnichannel presence. Mandarin Oriental is adopting an asset-light strategy, selling properties while securing management contracts, aiming to double its portfolio by 2033. The diversified conglomerate structure is a core strategic advantage, providing resilience when one segment faces headwinds, allowing others to compensate. While the outlook has positive elements, it's important to be aware of the risks. Property market volatility. Hong Kong Land faces headwinds like negative rental reversions in Hong Kong and disruptions from renovations, which will continue to impact contributions. The declining net asset value per share for Hong Kong Land also warrants monitoring. Contradictory financial strength indicators. As discussed, while gearing and cash flow show improvement, external metrics like the Altman Z-score signal distress, largely due to accounting impacts. Investors need to understand this nuance carefully. Execution risk. The ambitious strategic realignment and capital recycling plans are complex and carry inherent execution risks, potentially impacting short-term performance. Emerging market exposure. While offering growth, their focus on Asia makes them susceptible to economic and political volatility in those regions. Competition. They operate in highly competitive markets across their diverse sectors. In conclusion, Jardine Matheson Holdings offers an interesting profile for long-term, income-oriented investors. The underlying operational strength, combined with a consistent dividend policy and a proactive strategic realignment, provides a compelling foundation despite the reported accounting loss in 2024. Indications of undervaluation and recent insider buying suggest confidence from those closest to the company. However, it's essential to monitor the ongoing property market dynamics, understand the accounting nuances behind some financial indicators, and consider the execution risk of their strategic initiatives. For those with a long-term horizon and an appreciation for a diversified conglomerate, JMH presents a unique opportunity. This video is for informational purposes only and not financial advice. Please do your own research before making any investment decisions. If you found this helpful, like this video and subscribe for more content.